Good morning, Justin and Jay.
Good morning. I'm Justin White, and this is your Inside Pass. Let's bring in today's insider. Jay Montero Duarte is here, and we are talking about temporary rate buydowns. Jay, good morning.
Good morning, Justin.
So what should our clients know about our temporary rate buydowns?
Sure thing. So temporary rate buydowns is a way to set up the loan that lets the borrower ease into their mortgage by having much lower interest rates in the first years. So these can be paid in several ways, by the realtor, by the seller, or even by the borrower with a transaction. And these are offered in many programs: conventional, FHA, VA, also on non-QMs, bank statements, and jumbos, and even on refinance loans as well.
Jay, how should our clients sell this product to help get more business?
So Justin, buydowns are not just a tool, they are a strategy, because today, right now in this market, brokers can be giving rates in the 4%, which is going to make their offers incredibly appealing. And look, this is not only a strategy for brokers, this is also a strategy for real estate agents who, instead of lowering their sales price, they actually can be offering buydowns, to keep more money in their pockets, but also still be giving a great deal to the borrower. So it's incredibly important that our brokers are selling and talking about buydowns and offering this every single time, because not only will set them up for refinance in the future, but also this could very well be the difference between winning or losing a loan.
Great perspective, Jay. Thanks so much.
Of course.
Thank you, Justin and Jay, for this update on temporary interest rate buydowns. Let's examine some of UWM's tools for real estate agents to offer this option to their clients. To begin with, we're going to use United Wholesale Mortgage's Easy Qualifier tool to determine the actual loan size. Then we're going to use UWM's Buydown Calculator to get numbers that will tell us what the 1.0, 2.0, and 3-to-1 buydown interest rates and cost to the seller will be. And then finally, we're going to briefly go over the temporary rate buydown agreement that I have created so that agents can attach this to their offer and close more transactions. To complete step one is to require us to determine the loan amount and the interest rate. So I'm going to use United Wholesale Mortgage's Easy Qualifier, and just to make certain that everybody understands what all the conditions are, we're going to enter this information into Easy Qualifier, or EQ. So we have my name as the loan officer. Hypothetical borrower is going to be Fred Henry Allen, also known as FHA. And that's the loan type. He's going to do an FHA loan. We're going to propose that this be FHA. One of the advantages to a borrower for an FHA loan is that FHA will allow seller concessions up to 6%, whereas all of the other loan products are going to max out at 3%. So we're going to push this to the limit and do the FHA and be available to do 6% seller concession. We're going to have a situation here where we say the borrower is going to purchase this home. They're going to finance the funding fee. We're going to have a purchase price of $500,000 on a house that, of course, will have to appraise for $500,000. And FHA's loan to value is, 96.5%, meaning the borrower has to bring 3.5% to the closing. The actual loan amount before you add in the funding fee is $482,500. We're going to call this a primary residence. Single family home, not a condo. We're going to use the 80919 zip code, and we're going to pose that this borrower will have the 720 credit score, monthly income of $10,000, and we're going to propose locking this loan for 30 days. We're going to say that the borrower does not exceed a debt to income ratio that is over 45%. We're going to calculate that there will be some installment debt, and we'll just round that off at $350. I'm going to leave the taxes out and the homeowner's insurance because we won't really know that until a property is identified. We get the tax information from El Paso County Treasurer, and we get an insurance quote. We're going to say this borrower is not self-employed, and we're going to say borrower has 6 months of reserves. We're going to use in this calculation the 3-to-1 temporary interest rate buydown. and we're going to say that there are two borrowers on this loan. We're going to talk about the compensation paid to me, mortgage loan originator, and that's going to be at a 1% of the total, not the 2.75 that many loan originators charge. We're going to have a 30-year fixed rate term. We'll use a local title insurance company. I like to use Chicago Title. We're going to waive the underwriting fee that is paid to United Wholesale Mortgage, and we're going to waive the processor assist fee. Now, what that means is they're not really being waived, they're being included in the interest rate. If we were trying to get the absolute lowest rate, and if the borrower had cash, we would not include the underwriting fee, the processing fee, and the compensation. You'll see later how that affects the loan. So that's what we're going to look at here. And so as we scroll further down, we hit the get a quote sign, and here's what we get as the two options. This would be, as you can see, the best option is suggested to be the FHA Elite 30-year fixed with a buy down of 3-to-1 interest, meaning the first year of the loan you reduce the interest rate by 3%, the second year 2%, the third year 1%, and then years 27 to 30 is this interest rate of 6.487% with a principal and interest payment of $3,098.90, mortgage insurance of $220.02 for a total principal and interest with mortgage insurance of $33,1892. Of course, that does not include taxes. It does not include homeowners insurance. Now, EQ, Easy Qualifier, which is what United Wholesale Mortgage calls it, also says, well, this would work on a HUD-owned property. We're not going to use that. When we take a look at the details of this loan, you can see that this is the exact cost as about 8 o'clock Eastern time on Friday evening, June the 6th. The best option is the 6.487. That actually pays the borrower 2 cents. Here's the critical information up here. Here is the loan amount. When you add this financed mortgage insurance to the original loan amount, you get a debt for your new loan of $490,943.75. That is the number that we're going to plug in to the temporary interest rate buydown calculator so that you can see the actual interest and the cost to the seller to be able to make a seller concession of that amount. Now, you'll see here when we said we waived the PA plus, that's the processor assist plus fee, and we waived the United Wholesale Mortgage. This is pretty much standard in the industry. Most most wholesalers are going to charge something in that amount for their underwriting fee. When you get a credit here and expenses here, and then you have the compensation to the broker, $5,000, which is just shade over 1%. So that what you come away with is an interest rate of 6.487. Now, if a borrower had plenty of cash and wanted to get the lowest rate, we could change this lender paid to borrower paid, and we could eliminate the PA Plus and the United Wholesale Mortgage Company's underwriting fee, and then when we request a new quote for this hypothetical borrower, we get an interest rate of 6.007. Now that's the 30-year fixed rate interest. That's the note rate. And you'll see that the temporary buy down, when we use the calculator, is going to tell us how much they're going to save in year 1, year 2, and year 3, and that's what's going to be paid by either some sort of a seller financing concession. That's the way we take a look at the termination of the loan amount. You see again we have that same loan amount, $490,943.75. What you see that was in the other calculation when we used borrower paid and we included into the interest rate United Wholesale Mortgages underwriting fee and the processor assist fee. We got the same 490, but you have a substantially, or at least somewhat substantial, difference in the interest rate. So if you have a borrower who needs to get the lowest or would like to get the lowest rate and has the cash to make that possible, you're looking at an interest rate of 6.007. If on the other hand, the 3.5% down required by FHA, if that's already going to limit the borrower's ability to pay any additional costs, well, then we would incorporate those fees into the loan amount. That would be what we call borrower paid compensation. Next, we will move on to the input of this information into the United Wholesale Mortgage Temporary Interest Rate Buydown Calculator. We're now going to take a look at the United Wholesale Mortgage Company's Temporary Rate Buydown Calculation. We've inputted into the calculator that the loan was for $490,943.75, that the normal note rate would be 6.487%, and that was a rate that included the broker's commission, that includes the mortgage originator's commission, United Wholesale Mortgage's underwriting fee, and United Wholesale Mortgage's processor assist. So it number also does not include the mortgage insurance. This is just principal and interest. And you can see there are 4 different types of buy downs. You have the 1-0 buy down, which means in year 1 and year 1 only, you're reducing the interest rate by 1%. So you're reducing it to 5,487. That means the buyer is paying a monthly payment of $2,783.52, and they're saving $315.38 each month. That money comes from the buy down escrow account. You put the two together, they're paid to the investor, so that the investor gets their $3,098.90 for principal and interest. A 1-1 buy down means that you just do that for both the first and second year. So your total cost there is $7,569.12. So that's a concession of just a little bit more than 1.5%. Clearly, if you had a buyer who was not represented or had an agreement with the buying agent to work for a less than 3% commission, there could be room, depending, of course, upon what the seller's agent has negotiated in listing commission. The 2-1 buy down means that in year 1 you drop the interest rate by 2%, so you drop from 6.487 to 4.487. That's a savings to the buyer of $615.15. That's going to cost $7,381.80. Year 2, you go back up 1% to 5.487. That costs that same $37.8456 that you see in prior 2 years. So that is going to come to a seller financing concession of $11,166.36, which is 2.233% of the sale price. Year 3, which is the most dramatic, is dropping the interest rate 3% the first year. So instead of the interest rate that the buyer is obligated to pay, 6.487, it's actually 3.487. That saves the buyer $897.90 a month. It's going to cost the seller $10,774. You do the math then on the year 2 and year 3, the total price for that kind of a 3-2-1 concession on an FHA loan with the loan origination fee, the United Wholesale Mortgage underwriting fee, and the United Wholesale mortgage processing fee all incorporated so that it's not out-of-pocket cash for the buyer. That concession is going to cost $21,941.16. Now, if you recall, FHA is highest percentage of seller concession allowed. They will allow up to 6%. All of the other loan types, maximum seller concession is 3%. So this 3-2-1 buy down would only really work on an FHA loan. If you were doing any other kind of loan, you'd probably want to talk about the 2-1 buy down. Now, the question often arises is, what if this interest rate does go down and the buyer refinances? What happens to that money that was in escrow? Well, that money is always borrower's money. And so if they refinanced or sold the property, that money that's remaining in the escrow is going to be used to pay down the outstanding balance of the loan. Now, the next item we're going to look at is the temporary buy-down agreement that I have prepared and willing to provide to any real estate agent so that they can utilize that as a part of their offer. We're going to talk about that briefly in just a moment. The final document that you need, or tool that you need, to be able to successfully, I think, create a seller-paid temporary buy-down is to have an agreement that you either copy and paste into your offer to purchase, or you simply make it as an addendum. So I have prepared this document, which I think ideally you would use as an addendum to your purchase agreement. So as we scroll down here, you can get an idea of what we're talking about here. Simply, call this a seller-paid temporary rate buy-down. You got the seller's name, property address, purchase price, loan number, loan amount, buy-down type. That's where you would put in whether it's a 1-0, a 1-1, a 2-1, a 3-2-1 buy-down. Here you would simply insert the borrower's name and indicate that as consideration, for this loan happening, you're going to have a temporary buy down of the rate. This document is simply saying, whose money that is, where it's going to go, and I think taking the buy down calculator that you just saw and copying and pasting in this area right here the calculation. So if you were doing a 2-1 buy down, that be the loan type, the buy down type that you would be using. Simply copying and pasting that in here so that everybody can see exactly what the benefit is, how much it's going to reduce the monthly payment by, and what it's going to cost. And then just reciting what the total seller concession price is, making it clear that the seller is approving that is to be an allocation to temporary rate buy down, a recitation of the buy down calculation, what the note rate is. In other words, what the rate would be if you didn't have a temporary buy down. So in the example that we just used, you put the note rate in there at 6.487%, buy down reduction years. That's where you would again say it's whether it's a 2-1 buy down or 3-2-1 buy down. I have said here it's going to be calculated in the ease section of section H. What that really refers to is United Wholesale Mortgage has a proprietary origination software that is used to upload the loan into their system, run it through the automated underwriting system, and then generate the required disclosure documents, loan estimate, the closing disclosure, so that it's clearly and totally aware, all the parties are aware of what's going on. It's not just in this agreement, and this agreement is an attachment to the contract, but it's also clearly disclosed and complies with all federal laws. So that's what the ease section is. If you were using a different lender, you would calculate that in some other fashion. Here, just another way to restate what the calculator says. If you were doing a 3-2-1 buy down and you said the interest rate was 5%, you put the actual rate that was going to be, what that rate would be, the monthly payment, and the annual savings, which of course, as you understand, the annual savings are in fact, what it's going to cost the seller to make that concession, then clearly indicating to everybody that this is a temporary amount, buying that rate down. The rate will then revert to the exact rate that they qualified for. You want to be careful that somebody doesn't confuse this with an adjustable rate mortgage, where you're locked in for a rate for a certain period of time. Then after that adjustment period, it can change and can change often over the 30-year period. Here you have at the onset an agreement that this is what the note rate would be if there were no temporary buy down. Here's what the interest rate would be. Here's what the monthly payment would be. And once the funds have been dispersed for the buy down, that, okay, from that point on, you are back to the pre-approved amount. Here we talk about what would happen if the funds are not dispersed and there is a refinance. Then a place for the signature, the seller, the buyer, the listing agent, and the loan officer. That's relatively simple, but I think that this would be ideal to have this verbiage in your temporary buy down agreement so that it's a part of the offer. Everybody knows what it's going to cost, as opposed to saying, well, we'll give you a 3% seller concession. Well, exactly where is that going to go? You could have a seller concession that uses that amount of money for a permanent buy down. It certainly wouldn't be as dramatic a buy down and wouldn't change the interest rate and the monthly payment nearly as much, but it would change it over the entire life of the loan. Here you're giving them a boost of savings at the beginning, and as most people understand, very few loans are one-time situation in which you get a 30-year fixed rate loan and you never change it, you never borrow more money, you never refinance, you never sell the house. That's really not the way that a typical loan is originated, and the life of the loan, typically loans are going to last about 7 years on average. So you want to make sure that people understand this is an upfront benefit. So with that, if you have any interest in getting in touch with me, please give me a call. My name again is Lynn Chase. I am Professor Emeritus from Pikes Peak State College. I taught law to paralegals for 18 years there. Founded my mortgage company back in 2005. And I think that based on the current market conditions, that a temporary rate buy down will help buyers in the initial years of their purchase and hopefully deal with some of the affordability problems. Again, my name is Lynn Chase. My telephone number is 719-360-6015. Call me whenever